I'm going to be talking about five pieces of this whole presentation. We'll talk about the controller's role. We're going to talk about customers, costs, and cash. And as we indicated in the introduction, controlling with and not by the numbers. And I'm going to also talk about driver-based forecasting versus data-based budgeting. That's the new hot button issue in controller activities. It's called rolling forecast. I want to introduce that to you because if you're going to be an effective controller, you must get from traditional budgeting and understand this whole idea of rolling forecast. And then since we operate in virtually a paperless environment, I want to talk about how we control in paperless environment. Why is that important? Because we normally have a document that we can trace back through all transactions. But in today's technologically enabled world, we don't have documents. But we still have got to make absolutely certain that everything is okay and above board. So we've got to learn to control without documents. And how do we control in a paperless environment? Now, when you link all of these together, we're talking about how to become an effective controller in turbulent times. I think we all have to agree that these are turbulent times. Stock market just decreased by, 800 points yesterday, and it's been going down, trade wars. But the thing that impacts us most of all is what? Technology. Technology is changing the whole environment that we have to operate in within our companies. So if we're going to become a controller in these challenging times, we've got to learn to operate in this environment. And that's what I'm going to try to help us do in this next 50 minutes or so of presentation. I start off by saying, what is a controller? Everyone has a different idea what a controller is. So what do you think is the controller's role in today's environment? What is a controller? Here's what they are. If you're going to be a controller in today's environment, you're going to have to be a strategic partner. You're going to have company knowledge. Strategic partner means what? You're going to have to be able to participate in the decision-making of your company. You can't just be a person that provides numbers and let someone else use those numbers to make decisions. You've got to be able to provide solutions and participate in the decision-making of your company. You must have company knowledge. What am I saying here? Peter Drucker once said that the problem with finance people is that they think the companies make money. Companies don't make money, they make shoes. And we have got to understand how the company makes shoes because that's where the money comes from. Why is that important? If we're going to run the company with the numbers, that means we've got to know what the products and services are of the company and how those products and services can be married with the financial applications and implications. And you must know you must have company knowledge in order to do that. I want to look at financial analysis and process analysis in tandem. You got to be able to analyze financial information. The whole essence of running the company with the numbers is to be able to do what? Financial analysis and recommend some decisions and some solutions based upon that analysis. Now, a companion process of that is process analysis. Why? If we can do things in less time than we have done before, then we can make more money. Time is almost becoming a successful measurement of success as money. Notice I said almost. But as a controller, you must always be seeking ways to improve the productivity. That's process analysis. And here's the whole idea here, with and not by the numbers. I'm going to talk about that a lot in this whole presentation. What does it mean, running the company with the numbers as opposed to by the numbers? And then, of course, it's all about cash. Now, I can hear the controllers all saying that, well, we don't get involved in cash. Yes, you do. Many of the components that impact cash either coming into the company or going out of the company or things that are controlled by the controllers. So, yes, in a tangential manner, you do impact cash. because you impact the processes and procedures that either bring cash into the company or cash going out of the company. I want you to really think about this whole idea of information versus reporting. As an accountant, we do a lot of reporting. We crank out numbers left and right, and we provide those numbers to the decision makers, and we let it go at that. But that's not what's important as a controller. As a controller, you've got to be able to provide information. What is information? Information are answers to specific questions upon which someone can make a logical business decision. How many widgets did we produce yesterday? How many were we supposed to produce? Why didn't we produce that number? That's information. And I got to tell you, and I've been doing this thing an awful long time, and what we do is provide reporting, and then when the stakeholders get our reports, they go through them and pick out the information that they need, and then they move on. And you think you've done a substantial job for them, but you haven't really, because all you've done is given them lots of numbers from which they have to extract the relevant information that they need in order to make business decisions. We should provide that service to them. One of the things that's most popular nowadays is dashboards. What is a dashboard? A dashboard is normally just a visual and pictorial display of relevant company information. We always say a picture's worth 1,000 words, so we create a dashboard where the stakeholders can look at a very graphically presented presentation and glean some specific ideas and some specific facts from these dashboards. Very, very popular. If you don't have a dashboard for your company, you might think about providing one of those. Everybody wants dashboards nowadays. Okay, take a look at this. This is from CFO Magazine 2007. It says, controllers who want to become CFOs. Now, I know we're talking about controllers, but it's the same thing. You can also say that people who are accounting managers or chief accountants who want to become controllers, you can say the same thing. Need to put down their pencils and master soft skills. That was from CFO Magazine 2007. And it says, listen at this now, the perfect controller combines know-how, financial know-how. It didn't say financial doing, it said financial know-how with strategic thinking, presentation skills, and leadership. My first question to you would be, these are soft skills. How do you stand on presentation skills? How do you stand on leadership? All of these are very relevant if you're going to become this very effective controller in challenging times. And this is from a survey by Korn Ferry. If you know, Korn Ferry is one of the top HR search firms in the country. So, what are we saying? We're saying as a new focus controller, you got to do what? You got to get away from the accountant focus and get into the controller focus. Take a look on the left side of the screen. Accounting focus, we're talking about what? Numbers, routine, historical information, historical data. Versus controller, notice the absence of anything about numbers. It has to do with what? Relationships, leadership, and focusing on the present and the future. From an accounting standpoint, we do what? We focus on the past. So with the controller, we got to focus on the present and the future. Now, we can't ignore what went on in the past, but our primary focus is going to be what's going on in the company now and how that's going to impact what happens in the future. Which says we got to do what? Redefine our image. Redefine our image into something that means what? Masculine. Redefine your image. What do you think it is? Being a controller. What are the qualities of effective control in today's challenging environment? I want you to think about a couple of things. I'm going to flip up the next screen. What are they? What do you think they are? Here's what they are. Analysis of information. Controllers must do this. You must be able to take the information, analyze it, suggest some solution, and provide that to the company as a way of making a business decision. I always ask, when I do live sessions, I always ask controllers one thing. Here's what I tell the non-financial managers to ask controllers about this information. What is it? What does it mean? What am I supposed to do with it? And what would you do with it? And those are the answers when you talk about the analysis of information you've got to be able to come to grips with. What is it? What am I supposed to do with it? What would you do with it? What is it? What does it mean? What am I supposed to do with it? And what are you supposed to do with it? And I've always made it a habit of asking people when they bring me information or when they bring me problems, I've always asked them those three questions. What is this stuff? What does it mean? What am I supposed to do with it? And what would you do with it? And you get them to start thinking about not only the analysis of information, but how we can use it in order to make relevant business decisions. You must also have communication ability. I can't begin to tell you how many controls I run into that do not have the relevant presentation skills to be a strategic partner. We're so used to sitting back and not putting forth our ideas or our suggestions. You've got to be able to communicate that. Now, here's what you got to be able to do. You got to be able to communicate that on the level that the folks can understand. What we do too often is we communicate to them as if they were accountants, and they're not. And we must give them this information in something that they can understand. I did a presentation once for Starbucks Coffee, and Starbucks Coffee has all these regional managers, and they have a finance person assigned to each region, and those are the folks I was talking to about budgeting. And I was quite surprised that these financial folks who were responsible for providing information and providing assistance to that regional managers were mocking the idea that their regional managers didn't understand a lot of this complicated accounting stuff that we get into. One guy said, well, my boss doesn't even understand accruals. Can you imagine that? Not supposed to understand accruals. He's supposed to turn to you, and you're supposed to understand, and you're supposed to provide him the information in terms that he can understand. This whole idea about company and industry knowledge, you cannot be an effective controller unless you know company and industry knowledge. Know how your company makes shoes, know what your competitors are doing, know what's going on in your industry. And you must also have good leadership skills. What is leadership? Simply getting others to do what you want them to do because they want to do it. I'll talk about that a little bit later on in much more detail. But you got to be able to lead people. And I've had so many folks tell me that I don't want to be a controller. I don't like being a controller because I don't like dealing with people. Well, if you don't like dealing with people, that's probably not the thing you should be doing. Because if you're going to be an effective controller, you must be able to deal with this whole complicated, uncertain resource that we call people. And you got to be able to provide cost-effective services. Everything we do has to do with cost. We should always be in pursuit of the reduction of cost or the saving of cost, of being able to produce more effective services and be more productive with cost. And that's where that whole process analysis idea comes into. And then we must have some technical knowledge. Why? Because we can do a lot of things with the technological aids that we have available to us that will allow us to be much more effective and much more productive by using technology. There's a ton of technology out there. Look at the smartphones. There's so many apps out there, so many programs out there, so many software out there that you can use in order to improve the productivity of your companies. And that's always a part of process analysis. So what are you saying? If I got 10 steps in a process, sometimes you can use technology and eliminate 4 or 5 of those steps. And if I can eliminate 4 or 5 of those steps, that would probably suggest that I'm doing that process in less time than I did before. And when I do that, that means I'm being much more productive and I'm being much more cost effective. And if I've been much more productive, then that would also suggest that I'm going to become much more profitable. So here's what you want to become. Strategic partner, value-added decision maker. You got to be able to add value to the process. You got to become a decision maker, and you got to be a provider of solutions, not information, not finance reports. You got to provide a solution. Back to my question. What is this? What does it mean? What am I supposed to do with it? What would you supposed to do with it? You got to recommend solutions. As an accountant and all that stuff, we're so busy by generating lots of reports, throwing them on someone's desk, and being done with the whole process. No, you've got to be able to provide solutions. Facilitative change. In today's turbulent environment, change is constant, always. So if you can't deal with change, you're not going to be effective. And I'm going to talk about some specific ways that we can deal with change in a couple of minutes. And you got to be a provider of effective information, not a whole bunch of reporting, information that someone can use. Here's an idea. Okay, if I got several stakeholders, they may all have different needs for information. I've got to be able to provide each one of them the relevant information that they need in order for them to run their projects or to run their agencies. And I've got to become an effective leader. All this has to do with becoming an effective controller. So, take a look at these. These are the expanding roles in challenging times. Planning, that makes sense, right? Organizing, directing, measuring. I want you to focus on the last two. Financial analysis and process analysis. Now, why do I focus so much on the last two? Because that finance analysis is how we get to the idea of running the company with the business, with the numbers, or by the numbers. Running the company with the numbers and not by the numbers. And the last one is process analysis. People ask me, and I went from being a chief accountant to a controller to chief financial officer. I spend most of my time in all of those areas looking at what? Process analysis. I really had to because the company I was with went from 10 million to 275 million in 19 years. So I was always looking at the processes, trying to keep the processes up with this rapid growth. And we have got to do that even if we're not experiencing rapid growth. We have to do that because that means productivity. If I can find an easier way or a cheaper way or a faster way of doing a certain process, I'm going to be much more productive. And what is productivity? Getting more from less. If I can get more from less, then that means somewhere down the line I'm going to be much more profitable than I would otherwise be. Now, I've done this in live sessions, and I'm just going to give you a brief summation of it, and I used to get a lot of pushback from this. But I just want you to think about this. Here's a situation. You're in a company that has doing $10 million, and you've been in business for like 10 years. So the CEO walks in one day and says, look, I want to increase to $50 million in the next 3 years. And what should we do? How should we go about it producing this? And so what most of the folks would always do in the class is to start immediately cranking out spreadsheets and understanding how we could do this and how we could increase sales and supply chains and all these other objective items that accountants are used to. And what I wanted them to do is stop and think, wait a minute, is this possible? Is this possible? Can it be done? And why don't I stop here and ask the questions so that I can understand this vision and even challenge this vision with my knowledge of the company, with my knowledge of the industry, and then validate this vision. And now, after having done all of that, now I can go and communicate this to the rest of the company. And then we can negotiate the best results of what we now understand to be the vision of the president. If I went down and tried to get them to understand this without all of this, they'd laugh me out of the room. They say, how in the world can you expect us to do 30 or 40 million increase in 2 or 3 years when it took us 10 years to get to this level? So this is that whole idea of becoming a strategic partner, understanding the vision, challenging the vision, validate the vision, and then document the vision. That's what it means to become a strategic partner, and that's what it means to become an effective controller in these turbulent times. And if we're going to be a strategic partner, this is the normal expectation that we would be able to present and provide to the stakeholders of the company. We talked about change. There are 4 elements to change, and change is constant. And if we're going to be effective, we've got to be able to manage change. There is, first of all, an inherent resistance to change. People will always resist change. The first thing is to deny it, and then deny it, because if I can deny it, then I don't have to deal with it. Then they resist it. And why do they resist it? Because fear of the unknown. And then as you start to get into the change, they start to explore a little bit, and they say, well, wait, maybe this is not that bad. And so now that they explore it, then you have to get them to the point where they are committed to the change. One of Change Management 101 says you find the folks that will resist change the most and put them in charge or make them a part of the change process. That's Change Management 101. But we've got to manage this because change will be constant. And people will deny it. They will resist it. You've got to get them to explore it. And how do you do that? Communications and information. And then you got to get them to commit to the change. How do you get them to do that? Understanding the information and communication and getting those folks that you think might resist change the most, make them a part of the change process. How are you as a leader? We said leadership skills is one of the things we have to master. How are you as a leader? What kind of leader are you? Are you a focuser? Are you detailed, which is traditional? Are you a relator? You're a caring team player? Are you imaginative, creative, or future directive? Those are all the 4 quadrants of leadership. So which are you? You don't want to be in one quadrant and not the others. The real ideal is to be a part of all 4. And we do what we call situational leadership. Whatever the situation calls for, we're able to bring that to the table. Which one are you? If you like people, and by the way, what is leadership? Here's my definition: getting other people to do what you want them to do because they want to do it. That implies a whole lot of things. It doesn't mean you're doing things yourself. And its whole idea of leadership and management is getting things done through people. You cannot eliminate the essential component of people. So if you don't want to deal with people, it's going to be difficult to be an effective controller because that's the key resource in anything that we do. Now, I want you to pay real close attention to this because as a controller, you must be both. And a lot of people have some difficulty with it. You must be a trusted partner and an untrusting official. Sounds difficult, doesn't it? Yes, it is. But that's what you got to be. If you're going to be a strategic partner, people will trust you. You know, you have the keys to the kingdom. You know everything that goes on in the company. And so you are one of the most trusted individuals in the company. Yet you have to be a very untrusting official because you have to make certain that everything is done above board, ethical manner, based on processes, procedures, and the values and goals and directions of the company. You know what's going to happen? In most cases, the difficulty comes in people doing things that are unethical or against the processes or procedures in the company. They all come from who? People in management and high ups. So you got to be able to look at all of those folks, keep everybody in line, check everything, and when things go off the rail, you've got to be able to bring those to the attention of those folks. And so you got to always be looking for things, and that means you got to become this untrusting official. So what does it mean to be a strategic partner? Talked about it a couple of times, but what does it really mean? This is the overview of the controller's role. Here's what you do. I call these the three critical C's. As a controller and becoming a strategic partner, you have got to focus on customers, costs, and cash. It says that those are three C's. Customers, costs, and cash. What about customers? You got to be able to provide solutions, not just service. And you want to see customers, not just shoppers. Well, what's the difference? Customers are people that come buy your products and services, come back over and over again for an extended period of time. Now, not only do they come back to you, but they recommend you to others. Somebody once said that if they have a bad experience with you, they'll tell 10 or 11 people about the bad experience. They have a good experience, they may only tell 3 or 4. But you want your customer to be your marketing arm and your reference base. And you want to see customers and not shoppers. Now, one of the ways of doing this is to look at the lifetime value of your customers. What do I mean? Just take on a pro forma basis how much your customers will in business will do for you within a week's time. Multiply that times 52 to get an annual basis. And then how long can you expect a customer to be with you? 5, 10, sometimes 20 years. Think about your own experience. Some of you have been doing business with certain providers for 5, 10, 15 years. When you multiply all that out, you approach what's called the lifetime value of your customers. And if you start to treat them based upon this lifetime value, then I think you'll treat them a lot differently than you would if you just thought of them as someone that came in on Saturday morning and got the oil change and left and you never heard of them again. Here's what customers are concerned about: quality, delivery, and price. If you focus on quality and delivery, customers will pay the price. How do I know this? I once owned a machine shop, dumbest thing I've ever done in my life, because I knew nothing about the operation of a machine shop. I was doing some work for the Walt Disney Company. This was in California. And I was a small parts manufacturer. So they had me doing parts for these rides at Disney. They took them down once a quarter and redid them for safety purposes. And so they wanted to take them down on Wednesdays and have them back up on Thursdays. So they had me doing these parts. And they told me, they said, Carl, if you do a top quality job, deliver it to us when we need it, because we can't get the rides down that long, we'll be willing to pay your price. You can't gouge it. We want you to gouge it, but we'll pay you a reasonably competitive price. And so I said, oh, that makes sense. So I started to ask lots of other managers and customers and everything, what were the 3 key issues that they wanted from their providers. And guess what they all told me? Quality, delivery, and price. Sometimes delivery is over quality, but it's normally quality, delivery, and price. And so I stuck with that, and I made this a suggestion to everybody because that's what everybody wants. If you focus on quality, delivery, and price, you will have those customers for life. And you will have customers and not just shoppers. So here's something to look at. Why do customers leave companies? And this is based upon actual statistical information. 15% for quality, 15% for price. Notice 15% because they feel you don't care, and 39% because of how you treated them when things went wrong. So that says 70% of why customers leave a company all have to do with intangibles as opposed to objective kinds of things like quality and price. That's where what? Relationships come in, and you understanding how to build and maintain those relationships with your customers. Customers are always right. They are your business. Listen to what they mean and not necessarily what they say. What am I saying? They may say, well, your prices are too high. They may be saying that, yeah, I got to pay a high price for you, and it takes you too long to deliver the product. Or they may be saying your price is too high, and it's too expensive to do business with you because of your in-process, because of your administrative process with your product. So you got to always be able to sit and listen to your customers and understand what they really mean, not only what they just say. And if you're not sure what they mean, ask them, what do you mean? I know I hear what you're saying, but is that really what you mean? And you have to get at the core of the issue before you can solve the issue. And here's this whole idea of process versus product. Take a look at this. This is important. 95% of all effort to provide goods and services to our customers is what? Process. Only 5% of that effort is the product. Okay, what do customers find important? The process. What do the providers find important? The product. So you see, we're already out of sync. We're thinking product, the customer is thinking process. And 95% of what we do is process, only 5% is product. So what's the takeaway here? Think like your customer. If your customer is focused on process, you focus on process. Take a look at this. It's all about the process. Provider, process, 95%. That's how. What am I saying? How do customers order products from you? How do they get customer service from you? You call up folks, and everybody's into this IT stuff. You call up folks, and you get shifted around to 10 different numbers. Call this number. And then the next thing you know, you finally get to the number you're supposed to call, and it's the wrong number. And that's all about processes. People get very weary about that, so they won't do business with you simply because of how your process is too complicated. And then in terms of the product, it's only 5%. So if you look at your process, remember I said a few minutes ago that process analysis is key? If you look at your process and still keep trying to streamline the process and as to how customers do business with you, you're going to find that more customers are more willing to do business with you because of your process. Okay, let's see if we can validate that. Think of the worst buying experience you ever had from anybody. What was it? Was it the product or was it the process? And then on the other hand, think of the best buying experience you've ever had. And was it the product or was it the process? I think I just made my case. Here's the 4 things you want to focus on with customers. Find out what their needs are. That's all relationships and leadership. Provide your services to solve their needs. I was with the computerized income tax return process in business, and we did income tax returns for professional tax preparers. We had all of the data from everybody's tax return. And so the customers told us, look, why don't you give us that data in 2 or 3 pages so we can use that static data to prepare the returns for next year? You already have the information. It would be an easy process to extract information. So we said, that makes a lot of sense. So out of that discussion with our customers, we developed this process called a systemizer, where we would print out in a piece of paper, put a nice cover on it, all of the static information for one customer. And we sold it for like $2.50 or something, and we sold a gazillion of them. Simply by listening to our customers, understanding that they had a problem, and we fit our products and services to provide a solution to them. And we exceeded that beyond their expectations because we gave them this very nice package where they could use it to interview their customers and provide the information for this year's tax return. And that helped us to focus on long-term relationship with that customer. The other thing is this whole idea of cost. We said customers, cost, and cash. We're now at the cost. 15% of cost can be easily reduced. As a controller, you must always be looking to reduce cost. 15% can be reduced easily. Understanding that all costs are controllable. At some point, we've got to decide at what point we can control the cost. Some costs are only controllable at certain points. What I've always done, I've always looked at costs in 3 different pieces. Payroll and related costs, controllable costs, and predetermined allocated costs. Payroll and related costs, that's what are your benefits and your payroll costs. Those costs are only controllable at the time you hire the person. Once you hire the person, you got to pay them. Pay all the taxes, pay all the benefits. Let's skip down to the predetermined allocated costs. Those costs are only controllable when a certain event takes place. Like what? Building. You lease a building, you got to pay the rent. So you can only control those costs at the time you lease the building. Now, the other costs that are controllable in real time, those are the costs we must focus on. What are some ideas or some examples of controllable costs? Overtime, travel and entertainment, consultants. All of these costs where someone can say yes and you expend the cost, or no and you don't incur the cost. You should always be looking within your numbers what costs are purely controllable and focus on those costs. Overtime, all of these things are purely controllable. And so as a controller, you've got to be looking at those costs that are purely controllable and understanding that 15% of each cost can be reduced easily. And if you went into some type of process analysis, back to that word again, you can knock off 20, 25% of cost. Got to control the cost. Take a look at this. I mentioned I was in a high growth situation. We went from 10 million to 250 million in 19 years. We had 30, 40% of revenue per year. And this growth just made us drunk. We spent money like a drunken sailor because we were getting all of this money coming in revenue. And that's what people do. Take a look at this. Our revenue is going up. And we spent money right next to the revenue line. See the cost line going up? Now, what we should have done is to maintain our cost line at an optimum level. Now, look at the gap between revenue and uncontrollable costs. Not very much, is it? So, when revenue started to bend the other way and we started to lose revenue and customers, we ran right into the cost line. So now we've got to reduce costs in order to maintain some level of profitability. We should have stayed at the optimum cost line to give us a wider arc, or a wider gap in terms of reposition ourselves when the revenue line started bending the other way. Let's talk about cash. It's all about cash. Cash are the king or queen based upon your gender preference. Controllers don't pay enough attention to cash because they say, well, I have nothing at all to do with cash. I beg to differ with you. Take a look at this. You got to look at your cash-to-cash cycle. Cash-to-cash cycle simply says from the time I put money out in cash from the company, or I spend cash on the 1st of September, how long does it take me to get that cash back into the business? In this case, on the 15th of December. But look what happens between the 1st of September and the 31st of October. Inventory turnover, payment of labor, purchase of inventory. So all of these things are controlled by the controller. Inventory turnover. If we got inventory that's not turning over quickly, that's sitting on the shelves, if we got labor that's not being effective, not being productive, by the time we produce the products and services, we have spent lots of money in inventory, lots of money in labor. And then on the back side of that, we have to go and we have to collect from our customers. And so we have to focus on the average collection period, or as we say, the days sales outstanding. And we collect cash from our customers. Well, what do controllers have to do with that? How long does it take you to get your billing into the hands of your customers? Your billing process is efficient. And there's that word again, process. Your billing process, if efficient, can get your billings to your customers sooner. If they get your bill sooner, they pay sooner. We say, well, I got 30 days waiting period or something. But your customers start to count to 30 days from the time they receive your billing. If it takes you 15 days to get your billing, then they start to count 30 days from that 15-day period of time. So at best, you get your money in 4 to 5 days. You must know your cash-to-cash cycle and focus on these components: productivity of your labor, inventory turnover, your billing periods. Focus on those things in order to shorten your cash-to-cash cycle, because I want to be able to operate on the inertia of my own cash flow rather than having to dip into lines of credit and those types of things. Everybody should know that cash-to-cash cycle. Some folks call it a cash retention cycle, but it's really the cash-to-cash, cash recoupment cycle. But it's from how long it takes you from the time you put out money till you get the money back into the company. And you want to keep that period of time as short as possible. Okay, I always get pushback on this, but I'm going to do it anyway. Are traditional financial statements effective in managing an enterprise? Why? Everybody says, well, sure. Otherwise, we wouldn't do that unless they were effective. Well, but I want you to take just a little bit different approach to it. I want you to look at this picture. I'm going to put it back up again in a different scenario in a couple of minutes. In accounting, we record and report past transactions. We spend way too much time focusing on those past transactions. Once they're done, it is what it is. It's past. And finance is this whole idea of looking forward. Looking forward based on the present and the future. I think I mentioned that a little bit some time ago. So as a controller, I want you to look at in the rearview mirror down the road of the future as opposed to always focusing on what we do in the past. Now, obviously, we can't ignore the past. We have to take what went on in the past and use that to plan for and to direct our future. But our whole focus point should be on the future as opposed to the past. So, what does this mean beyond the numbers? We talked about that. We said, what does it mean running the company by the numbers or running the company with the numbers? It's simply a matter of being reactive or proactive. If I'm going to run the company by the numbers, I'm always focusing on the past. Something happens, I start cutting costs, start cutting prices, raising prices. I'm always reacting to what went on in the past, as opposed to taking that information and saying, well, how can I make this a win-win situation for me in the future? How can I be proactive? How can I use this to focus on the future and achieve better results than I did in the past? It's that whole idea of being a controller and a partner that looks forward as opposed to an accountant that always looks backward. I've always just been completely turned off by these sessions we always have. We close out the books on the 15th of the month, and then we spend hours looking why someone spent $35 45 days ago. What difference does it make? And meanwhile, the company's going to hell in a handbasket, and we're worrying about why someone spent $35 in the. It's kind of like a credit card. If I have a credit card that has a $2,000 limit, and I go out and I spend $1,000, there's no mystery to me about what my bill's going to be. My bill's going to show I got a $2,000 limit. I spent $1,000. I now have $1,000 left. There's nothing I can do about that except change my buying habits for the future. And that's what I'm talking about when I say by the numbers or with the numbers. I can't go back and do anything about the money I've already spent, but I can say this $1,000 that I have left has to last me for a year, so I've got to change my buying habits. So I'm being very proactive and I'm focusing on the future based upon what went on in the past. And that's the whole idea of with the numbers as opposed to by the numbers. What do CFOs really want from our financial managers and controllers? You know what, folks? We give way, way too much information. They don't want that stuff. They want what you, comparison to plan, summaries, dashboards, and they want you to focus on things called key business indicators and key business drivers. And the most potent weapon we have is called trends. I was with Ross Perot's company for like 6 years. And the monthly reports we put, I had 3 lines to it. You know, budget, actual, variance. And if you wanted to dig deeper, you had asked for to go for it. But think about this. We get way too much information. Think about comparisons to plans, summaries, dashboards, key business indicators, key business drivers, and trends. And this is how you're providing information and not just reports. Take that information. Notice we said what? Financial analysis. Analyze that information, present it to your stakeholders in ways that they can understand it, and you'll be much better off. And here we talk about trends. Here's what you want to look at. Sales volume, gross margins, pricing and product returns. Why is that important? Notice sales volume, everything starts with that, and gross margins. We understand that, but why is pricing and product returns? Why is that so important? Well, it might be that we're offering the wrong kind of products, and folks are not buying those. They may be saying our pricing is too high, but they may be really saying you're selling the wrong kind of products. And if we're getting returns or lots of returns on one type of product, that would strongly suggest to us that that's the wrong kind of product. And direct labor is always an issue. Overhead is always an issue. Why? Because we can't really measure the effectiveness of overhead. And so we must always look at SG&A. We call that indirect labor, but we must always look at that because there is no real good way to measure how effective the overhead is compared to the sales volume and profit. There is a universal tendency for us to have way too much in inventory. Most companies have too much inventory. When a turnaround specialist comes into a company, and I happen to know that because I am a turnaround specialist, first thing they look at is what? Inventory. Everyone has too much inventory. So we look at inventory, try to reduce the amount of inventory, and to the extent that we can reduce inventory, and in 99% of the cases we can, that results in a direct increase in profits. So, information versus reporting, dashboards, summary highlights, key business indicators, and key business drivers. These are the things as a controller you should focus on. What's a key business indicator? Those are the things that relate to everything across the country, rather. And a key business driver, those are the things that influence and impact your entire business. What are they? Sales volume, customers, new, renewals, whatever. Look at those things and focus on those things that impact the company. Not just a lot of stuff that doesn't have any direct relationship to either sales or profits. I'm going to talk about this whole traditional budgeting versus database budgeting, rolling forecast. Of all the webinars that I give rolling forecast more than any other. Everybody is on the rolling forecast bandwagon. So I want to cover this for you initially in this session, because if you're going to be an effective controller and you know nothing about rolling forecast, I would strongly suggest that you look and see what this is all about. Here's what we do traditionally. Plan for current year. And in that budget becomes the current year. We look at what we did last year, and we just keep forecasting the actuals within the quarter based upon how the budget is performing. And it kind of looks like this. We set up 4 quarters. First quarter, we go what? We look at how we revenue and expenses, and we reforecast the last 3 quarters. Do the same thing in the second quarter, reforecast the last 2 quarters. And by the time we get to the third quarter, we jam everything into quarter number 4. And that gives us a lot of ups and downs in our forecast, use it or lose it mentality and those types of things. So we think that's a better way of doing that, and we know it is because we know there are several things wrong with this whole budgeting process. What are they? Think about 3 things that's wrong with this whole budgeting process. Here they are. Too time consuming. I've heard folks tell me it takes them 18 months to do the budget. Too time consuming. And the budget is based on assumptions and historical data. We look back and we say, well, we did this several years ago or several months ago, so let's plan on doing that again. But we're in turbulent times, folks, so that may or may not happen. And it promotes this, what we call the spend-all mentality. If it's in the budget, we have to spend it by the end of the year. And we're so afraid that if we don't spend it by the end of the year, someone's going to come along and take it away from us. And that's not a good way to run a railroad. So, what's wrong with that traditional approach? We compress everything in 1 year. We never look beyond that 1 year. It creates this bountiful and lean quarters, and it creates this loser to use it mentality, and it focuses, and here's the real key, it focuses on past data, not future business drivers. So what a rolling forecast. We focus always on the future, and we focus using key business drivers on a continuous basis. And we use a what-if analysis to add and drop certain forecasts over a consistent period. So let me show you how that works and what we're talking about here. Back to the same picture. I'm trying to get us to do what? Focus on the future based on key business drivers in our forecasting. Not just focusing on what we did in the past, because what? The climate is changing, and so our focus should be on the future and not on the past. And we call that the front windshield approach as opposed to the rear view mirror approach. So here's what we do. We set up an initial 15-month forecasting period based on key business drivers. And each 3 months, each quarter, we're going to add a quarter and drop a quarter based upon a what-if forecast based on key business drivers. And we're going to keep doing this, rolling and rolling and rolling this forecast from this basic 15-month baseline forecast. And it looks something like this. First year, we do what? 15 months. It's 5 quarters. And then at quarter 1, we look at how the budget's performing. So we drop a quarter and we add a quarter. Notice in the first 15 months, we're already into the first quarter of next year. So we drop a quarter and add a quarter. Quarter 2, drop a quarter and add a quarter. Quarter 3, we drop a quarter and add a quarter. Now, when we get to quarter 3 and we drop a quarter and add a quarter, we have effectively set a plan or a forecast for our entire year 2. Now, obviously, we got to tweak that and change that based upon things that might happen currently or for the future, but we're looking at the future all of year 2 when we get to year 3, or quarter 3 of the current year. And we keep doing this drop, add, based on what-if analysis. And it just keeps rolling and rolling and rolling along. And we always keep that baseline of 15 months. And of that 15 months, we take those first 12 months and we establish those as our budget. And we also establish those as our baseline for pricing and for our production metrics, et cetera, et cetera. So if we talk about key business drivers, what are key business drivers of your company? Well, it's very simple. Here they are. Customers, revenue, and cost. Those are the things that drive your business. New customers, renewals, retentions, customer losses. Those are the things that will impact revenue. Customers give us revenue. If we can increase, decrease, or remain the same, and then our revenue is a function of customers, and our costs are normally a function of revenue. So these are the things we need to focus on going forward when we set up our 15-month baseline for our rolling forecast, and as we continue to add and drop quarters, add and drop quarters. And then, of course, our profit or surplus is simply the difference between our revenue and our cost. And then, of course, we must always consider cash. Key business drivers, business forecast, rolling forecast. Internal controls. Here's how we control things. You know, one of the things that gets us in the trouble is that word controller. Because we think we control everything. As a controller, you don't control anything. You are an enabler. You are a partner. You're helping people to achieve certain goals and objectives of the company. And we get so hung up on this word controller that we get all out of whack in trying to control things. But it is through internal controls that we can create this climate of control. And I'm right back to this again, being a trusted partner, untrusting official. It is up to you as a controller to put all of these things we're going to talk about in place that would allow you to control the company and control all of these things, particularly in a paperless environment. We talk about internal controls. What are we saying? We're simply saying 1 ounce of prevention is worth a pound of cure. That's all controls are, and that's all we are supposed to be trying to do is to make certain that this ounce of prevention is worse than a pound of cure. So, if we're going to be this strategic partner, internal control must become our primary focus. This is how you control. Let's take a look at it. Here are the things that you got to be able to do. You got to have a defined lines of authority and responsibility. We're talking about written processes and procedures, folks. Who can do what, when, how, who can sign checks, who can approve payments. All of these things must be documented in writing so that everybody understands that, and they must be the idea of separation of duties. No one person should be in complete charge of any one transaction. We have to have authorization procedures. Who can approve purchases? Who can approve contracts? Up to certain levels, do I need one signature? Do I need two signatures? All of these things have got to be identified in writing. I've got to make certain I have good documentation and record keeping. And am I maintaining my records according to the legal requirements? And this next one here is the one that I'm particularly fond of. Not fond of, but I want to challenge you. How many of you can go and look at all of your capital assets? First of all, do you have a process for the acquisition of assets? How you identify them? How you make certain that they are controlled within the company? But most importantly, how many of you can go and look at your assets and can find them physically and identify them to what's on the books? How many of you can do that? If anyone can do that, you should get a star for the class. Most of the folks can't. And that's what you need to be focusing on. You need to, first of all, set up a threshold for your capital assets and don't capitalize anything under $1,000, $1,500 or whatever you can afford. Make certain that they're assigned to a certain department, assigned to a certain person. When they go from one department to the next, you have a paper trail. And all of these things have got to be, because if someone came in and there is always an actual to book adjustment, we go in and we can count what's on the books, and to the extent that that doesn't agree with what's on the books, then we must reduce the books. And how do you reduce the books? You reduce the books by a write-off that hits your expense and your bottom line. Must always you got record-keeping procedures and independent verification. If you don't have an internal audit section, you got to become that internal auditor yourself. Now, a lot of this stuff is tough to do in small environments. But you got to make certain you document it. You got to make certain you look at it and make certain that you follow all these principles of internal controls in your processes. So we're back to what? Process analysis, technology, company knowledge, information analysis, and this whole thing we call forensic accounting. That's become a hot button issue nowadays. What is forensic accounting? Nothing more than a deep dive into a certain process. I know a guy who has a PhD in forensic accounting, and what he told me, in order to be a good forensic accountant, you got to think like a thief. Now, can you do that? When you're doing deep dives into your processes and procedures, you're trying to keep thieves and people from stealing from you. So you got to think how they think. And that allows you to put up guardrails and controls around all your processes so they can't get through. Here's some new trends we have in technology and accounting nowadays. You know about FASB and ISB. FASB is Finance and Accounting Standards Board. That's being merged with International Accounting Standards Board. If you need a good reference point or a good reference for anything control-wise, look at CFO.com. The new statement formats, I'm not quite certain how widespread these are now, but we're heading down the path of converting all of our traditional financial statements to statements that look very much like the cash flow statement. I've seen some of these where I was doing a red line analysis for a company, an American company that was merging with an Indian company. And lo and behold, the financial statements, I got at it, my Lord, what is this? And they're in the new format, which looks very much like the cash flow format. And you can follow them through. They're not that difficult. Current value accounting, we're going at some point ask all the controllers and accountants to express all the traditional financial statements in current value. That's going to require lots of assumptions, but that's coming. Just RFID, radio frequency identification versus BOCOs. That's how we can interact with inventory without having line of sight. Everything is done through a transponder. Forensic accounting, that's a deep dive. White collar overtime is coming back online. It was supposed to have come online a year or so ago, but it's now coming back online. They're talking about it now. In addition, with lots of states and companies increasing the minimum wage for their employees, we're looking here at changing the dollar threshold for exempt versus non-exempt employees. Right now, it's like $27,000, $28,000, way too low. So they're going to increase that. That's going to mean that many of our exempt employees may end up in the non-exempt category, and all of that will mean something to us because we're going to have to pay overtime, lots of record keeping, and the whole myriad of things we have to do. And of course, we talk about rolling forecast. Okay, that about says it all. I think we got about a few minutes left for questions and answers. So